It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. Great to be with you. Here with me in the KFG studios, no Josh Gregory today, but my business partner, actually founder of Korhorn Financial Group and one of the CFPs on the team, Kevin Korhorn.
Yes, missing Joshua Gregory today. So your age can influence what financial options are available to you and therefore can influence your financial plan and decision making. What are those important ages? Not just for you, but also for your children and other important people in your life. So we're going to run through your entire financial life and the ages of that life, pointing out the inflection ages so that you can plan ahead. That and more on today's episode.
That's right. That's right. If you have a question for the program, we'd love to hear from you. You can reach out to us a few different ways. You can find us online, wisemoneyshow.com, and engage with us that way. You can call or text 574-222-2000. That's 574-222-2000. Most engagement comes on social media, typically YouTube channel. Go check that out, or wherever you're at in social media. Search the Wise Money Show and follow us there. So what is it, Kevin? The 60s, the new 50? You know, when I was going through college, they said, well, 30's the new 20s. And that, like, in college, that was like an excuse to say, well, you can do whatever you want. Make as many, terrible life decisions as you want because, you're still young. And, I don't know. It's confusing. But whether you're actually young in age and you're trying to gain some wisdom, or if you're maybe older in age but young at heart and trying to make some great financial decisions, the age that you are, the actual age, not what you feel, your actual age influences your finances. And I started making a list of some of these important ages, and guys, there's a ton. There is a ton. And so we're going to run through all of them, okay? And we might miss a couple things here or there, but there's a lot of ages you need to remember. We're going to go chronological order and what ages really influence your financial options, your decisions, your financial life. We're going to start at age 18, but Kevin, before the show, you were saying, it's more so 21.
Yeah, well, I like 18. 18 is the earliest age you'd be eligible to contribute to a 401k, which is great. The issue is, and we have an entire department that handles retirement plans, whether it's 401ks or simple IRAs or single Ks, all different flavors, 403bs, go on down the line. So most plans by default make it so that you're not eligible until age 21. Mm-hmm. I understand why that is. And if you're a conspiracy theorist, and I'm not, in spite of all those people.
You are.
Okay. Yeah.
That's a conspiracy.
Okay, maybe I'm. So, but if you talk to all of the people in the retirement plan space, the people that do the work, the third-party administrators, the record keepers, the plans, all these people, what they want is they want their lives to be simpler and easier, and I get it. So I'm not blaming them. But I was just talking with a big national insurance company and their TPA, and I said, hey, there's not a Roth option in this plan. There's not there's not auto enrollment.
Yeah, some of the normal features these days.
And they said, look, we don't really want to do that because of the HR nightmare that creates. I'm like, yeah, it's not easy, but who are we here to serve?
Yeah.
Because if we're here to serve people and change the world and make people's financial lives even better, then we have to be willing to put up with a little bit of pain and make a little bit of sacrifice to help. Because we're not going to save everyone, and that's okay. We just need to save the people that we can save. So the 18-year-old, if you're 18 or you know someone who's turning 18 or you've got a son or a grandson, daughter, whatever, I would encourage them at 18 to start saving.
Yeah. And
if they can't save, if their employer doesn't have a retirement plan, help them get set up and start. If they have earned income,
Yeah.
start getting some money into an IRA.
Most people ask this question when they've got young kiddos or whatever that are starting to work. Hey, how old do you need to be to open a Roth IRA? You need to have earned income. And so the 401k, at age 18, or some plans at 21, there's an age limit. But for Roth IRA, you've just got to have earnings. You got to have earnings, paycheck money is what Josh says.
Yeah, you got to get your earns on. So, so at 18, it does become simpler because you can set up a Roth IRA at basically any financial institution.
Right.
There are a few that let you do it if you're younger than 18.
The parents, at age 18, your kids, the child tax credit changes. But this isn't about you. It's about the ages. Okay, so let's go from 18 or 21, whichever, right? Let's go to age 26, Kevin. What changes at age 26?
Well, at age 26, you are bumped off of your parents' health insurance.
It's now required. Now, I'll tell you, I was talking to a couple of our health insurance all-stars yesterday. And when I say talking, they texted me. Okay, so it was, how many families have their health insurance where a child, 22, 23, is still on the parent's health insurance plan, but that child could move to their own health insurance plan, reducing the parent's cost and adding a little cost for the child, but numerically it still makes sense, and that allows the child to contribute to an HSA. So the age here, so I guess I just wanted to point to a bigger strategy there that we're going to be talking about more in future episodes. But at age 26, you have to be off mom and dad's health insurance. You got to be on your own.
Yeah, and the Affordable Care Act bases the cost of insurance on your income.
Right.
So if you're 26 and you haven't gotten really started into making lots of money, it's quite possible that your insurance costs you $50 a month or something like that.
Exactly. And
a nice plan.
And for parents, if you're wanting to fund HSAs and do some tax savvy things, moving your son or daughter onto their own plan will reduce your cost. Theirs might be, like Kevin said, if they're only making 18, 15 grand a year, something like that, their cost might be minimal, but it opens the opportunity for you to still contribute a family amount to your HSA, but also an individual amount to that child's HSA. Pretty cool strategy.
Well, and the thing that makes that strategy so cool is this is a show about financial planning. There are 6 formal areas of financial planning. That hits almost every one. That hits your present financial position. Do you or your children have sufficient funds to fully fund an HSA for yourself and for them? Protection planning, that ties into what is my insurance going to look like?
Yeah, health insurance, your actual coverage.
Tax planning, it's better to fund it via payroll deduction than write a check, but I can do either one, and I can write the check up to my tax filing deadline. Investments.
Should you invest this money? I think of that for these young kids, right? You've got to get started early to be ahead of the game, especially with inflation and the other challenges that we're facing financially right now. Starting early, and gosh, if I've got a 22-year-old who's maybe still living at home and they're not making a lot of money or whatever, but we've got the resources to fund their HSA, I'd move them to their own plan. I'd fund that HSA, and I would invest that. So you're starting early and use that for retirement.
So if you're investing that also ties into retirement planning.
Yep.
So, I mean, you ring the bell in 5 of the 6 areas, which is why you need an integrated financial life. And so when you think about turning 26, you now need an operating system for how you're going to deal with your health and your health insurance and all of the other options and opportunities there.
Yeah, that's right. So I'm just going to tell you right now, it's going to be hard for us to fit all these ages in, but it's so good, guys. It's so good. There's nothing big that happens in your 30s and 40s. I'm going to grill Kevin, see if he can come up with some, but the next one that I come up with is at age 50. Now, does that mean, well, finances in my 30s and 40s not important? No, guys. You're grinding. You are grinding during that time. That is a time when, yes, you're having kids, you're a bigger house and bigger cars and all that stuff. You better be making progress in your finances. That's crunch time. That's grinding. The next inflection age is at age 50. There's several that come after that. We're going to hit all that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel every Saturday morning at 10 a.m., also on podcast at the same time, wherever you listen, check it out. And then a couple local radio stations here in northern Indiana, southern Michigan. That's why the content's an hour, because it's the airtime that we have as well. If you're not into this long of content or want something more pointed, we've got content that we drop all throughout the week as well at 8-10 minutes long that takes one financial concept, applies it to your financial life to help you make wise financial decisions. If you're about that, you've got to hit that subscribe button, turn on notifications so you're made aware every time we drop new content. Thank you very much. Yeah, there's no way we're going to get through all this. That's okay.
So I think if you picked up then in the 30s and 40s and just reiterated, because in those years more than really any other time in your life, you're going to have more opportunities to spend money. And so developing your financial discipline and financial skills and financial muscle. And if I was in my 30s and 40s and I had parents or grandparents that had resources, I would be demonstrating those skills.
Oh, interesting. I want you to say that on the air, too.
Because I want them to see. And then the other thing, at age 40, the warranty expires. Like your body starts falling apart completely. So
so both of those, especially because of the number of ages, we can't focus on those.
No. So we gotta burn through it real quick.
All right. Sounds good. What are the most important ages in your financial life? There's actually a lot of them you need to be remembering, you need to be aware of, and be planful for. We're going to help you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn. Make sure you check out the Wise Money Show on podcast. If you've never listened, go check it out. Wherever you listen to podcasts, search the Wise Money Show, subscribe to it or follow us there. Rate the program as well. We appreciate it. Just recently got into Spotify. You can make your own, it's Joe Rogan. So I've gotten into that more. And so checking out the Wise Money on Spotify, anyway, I've always listened on Apple and I'm finally growing up, maybe. I don't know. Speaking of growing up, okay, what are the most important ages in your financial life? We just hit, the early ones. And I would just remind you, in your 30s and 40s, there aren't these big IRS ages or deadlines or whatever. Those are crucial years in your financial life, right? Kevin, we were talking about this over the break. You're establishing your financial disciplines, your habits. You're demonstrating, you're building your character and showing your, growing your skill set in order to manage and handle more resources as you grow and are older. You're going to have huge capacity to spend a lot of money, but you've got to make great choices so that you don't have too much of it slip through your fingers and that you have the skill set to manage and be a good steward of it.
Yeah, it takes skill and character to manage money. And if you're listening to this and you're in anywhere between 25 and 50, I can tell you this, there are financial planners right now meeting with your parents, helping them with their estate plan, and they're saying, we have 3 children, and this one is clearly the most ready. The readiness level of this child is where they can step in and take care of stuff in the event that we're not able to. So I would encourage you to do a couple things if you're between 25 and 50 and you're listening to this. Work on your skill, your financial skill. Work on your character. Work on the budgeting process. You're never going to have more opportunities. You're going to have, if you probably have kids, you have all these things going on, more opportunities to spend money. I would try to set a goal to just say, hey, listen, I want to come as close as I can to max funding any limits that I have. And I would think of a couple. I'd think of your retirement plan at work, your IRA outside of work, your HSA, and your 529. And so those 4 things probably need to be funded at various levels. Yep. And that's where you want to be working with a financial planner to make those resource allocation decisions, because you've got finite resources and infinite choices. That's so right. If you can get those right in your late 20s, 30s, and 40s, your 50s, 60s, the rest of it's going to be a breeze.
Easier. easier than it could be. Okay, at
Yeah.
age 50, that's the next big age. What happens at age 50? This one should be a little obvious.
Well, the year that you turn 50, you can do catch-up contributions.
Yep.
So if you look at the two places that a lot of people save money for retirement, you have an IRA, and that could be a traditional IRA, which is likely pre-tax, or a Roth IRA. So I've got my IRA, and then at work, I likely have a 401k.
Or maybe a 403B if it's a nonprofit. And at the year you turn age 50, even if you turn age 50 on New
December,
Year's Eve,
yeah.
right, which would be weird, but you can save that additional amount, this catch-up amount, that entire year. So budget for that, plan for that, do tax planning for that. For those IRAs, a Roth IRA, that catch-up is $1,000. Okay, so it moves your contribution limit from $6,000 to $7,000. For the 401k, what is it, Kevin? It's still $6,500, I believe. So it moves your $20,500 normal contribution plus another $6,500 gets you to $27,000. I mean, that's a number you got to budget for. You got to plan for that, and you don't want to show up. We had this, I remember vividly, a couple of months ago. Had someone show up. They're 52, and they're like, "Yeah, I'm maxing my 401k," and you look, and you're like, "Yeah, you're maxing the old limit. You're not doing anything for the catch up." And so that's important at age 50.
Yeah, you're early enough in the year. If you're turning 50 this year, but you're not yet, go online right now. Go to your 401k and bump that up.
Goose it up. Okay, age 55. Now there's two of these here. Speaking of catch-ups, at age 55, if you're on the HSA, that's when your catch-up contribution happens for your HSA. Why not at age 50 like everything else? I have no idea, because they have no idea what they're talking about when they're making rules. They just don't. I don't understand why the HSA would have a catch-up that starts at age 55 instead of age 50. Makes no sense to me, but that's one. Your HSA catch-up contribution, which is an extra $1,000 for each of you, but there's some unique issues there we're not going to get into during this show, but that starts at age 55. There's a second important thing that happens when you turn age 55 with your 401k and being able to draw dollars out.
Yes, and again, this is the year that you turn 55.
Yep.
Because we had a great listener question on that. Thanks, Will. So the year I turn 55, if I retire in that year and with my retirement plan at work, if my plan document allows, what I'm able to do is I'm able to pull money out of my retirement plan, pay taxes on that if I've never paid taxes on it, but avoid the 10% early withdrawal penalty.
Now, this is from your 401k. Your plan needs to allow it, and you've got to retire in the year you turn age 55 or after. Did have someone who's probably listening right now who left his employer for, not really in his control, but a few months before, like in December of the year that he turned 54, even though he was turning 55 a few months later. And that doesn't work. And so some nuances there, but age 55 is important. The next big age, though, is 59 and a half. Why a half year? Once again, because these lawmakers have no idea what they're doing. That makes no sense. We speculated last time that it was, someone wanted 59, someone wanted 60, and they just said, we'll split it. I have no idea if that's true. It has to be true. But at age 59 and a half, that's where the rest of your retirement accounts you can begin to draw out without that early withdrawal penalty. Right, Kevin?
Yes, and another significant thing that happens, so to your point, Mike, if you're retired or you have IRA money, you can take a distribution and only pay federal and state taxes if the state you live in charges state taxes. But the other interesting thing about age 59 and a half, with most retirement plans, in the event that I want to, I can access that money. So I've got a strategy that I want to run in an IRA. I can't do that strategy in my 401k. Well, hey, I can move that money over and I'm off to the races.
Well, investment strategy, investment options, a 72T SEPP distribution, and there's no jargon here, but that's a way of accessing dollars without paying. Oh well, at 59 and a half, no, you wouldn't need to worry about that. But
No, but this is the 59 and a half age is interesting because if you're backing up and you said, hey, I had an event and I'm able to retire at 50, you can actually, and this is technical, we won't go into it, but you can actually access those dollars just paying federal and state taxes, not the 10% penalty.
Yep.
That's called a 72T or SEPP, and it's, it is a jargon-free zone, so I'll just stop right there. But you can. Just know that you can.
Yeah. This one, we hit this just a couple episodes ago, but this one isn't the year you turn age 59 and a half. This is actually age 59 and a half. And so if you start drawing money out of your IRA in the year you turn age 59 and a half, but you're not yet age 59 and a half, those dollars will be considered early withdrawal.
Makes perfect sense.
Yeah, it does. Work with your CFP on that. All of that. If you're needing cash around that age, you better be doing comprehensive financial planning. All 6 areas of your financial life are involved. Your CFP will help. Lots of other ages coming up here on the Wise Money Show with Korhorn Financial Group. Yeah, so okay. I wanted to make that comment, but it didn't quite connect to what you're saying. So let me just remind you guys of that. So if your 401k plan allows for in-service rollovers, in-service transfers, means you're still working there, but you're allowed to transfer some dollars to an IRA, and you're looking around saying, well, we've saved up enough, or for whatever cash flow reason, I need to pull some dollars out. Pulling dollars out of your 401k, not easy. You've got your 401k loan that has a 5-year payback, and there's limits on that, blah, blah, blah. There's hardship, but some plans have that, some plans don't. That's about it. Within an IRA, though, if you're able to transfer your 401k to an IRA while you're still working, that's this in-service withdrawal, then you have a few additional options to draw money out of an IRA and not pay tax on it. Still pay tax on it, but not pay a penalty on it. And so explore those options with your CFP. I mean, that's going to apply to maybe 1% of the population, but if it's you and you're in need of some cash, knowing the creativity there, those different rules, beneficial. Yeah. All right, we'll pick back up at age 62. Third segment. In your 50s and 60s, lots of important ages in your financial life, and we're helping you with those right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn. Every episode of the Wise Money Show is on the YouTube channel. Lots of other content there as well, so go check that out. Go to YouTube, search the Wise Money Show, and subscribe and follow us there. Turn on notifications so you're made aware every time we drop new content, which we do all the time. Talking through the most important ages in your financial life so that you can be prepared. Because financial success, a lot of it is determined on your ability to get proactive and plan ahead for upcoming financial transitions. Yeah. And I can't say that as eloquently as Josh Gregory would, but he's not with us today, so that's my best attempt. But so it's important that you know these ages, these inflection points in your financial life, that these rules change, so that you can properly plan ahead, be proactive, and be prepared for these transitions. 62 is a big one. 62 is the earliest age at which you can draw Social Security. Now, if you're a widow or widower, that age is actually 60. Hopefully that's rare, okay? So for everyone else, it's age 62. Now, the challenge, though, is it's not the wild, wild west at that time. If you got earned income, then and it's above a certain amount, then drawing Social Security at age 62 or early could penalize your Social Security. And there's a way. I've had some people where they say, well, my plan is I'm going to move to part-time at age 62, turn on Social Security, and between going part-time and making $40,000 and my Social Security, I'll be okay. And it's like, you can't do that. I mean, you could, but if you work part-time, earn $40,000, your Social Security will be penalized to nothing.
Yeah, think in terms of about $18,000. Yeah. I can make about $18,000 without my Social Security being reduced. For every $2 above that, they're going to take back $1 of my Social Security. Yep. Now, I have had folks that said, okay, well, if I work part-time, I'm going to make $30,000. So I shouldn't do that. I shouldn't work. I'm like, no. You're ahead, giving back some of your Social Security. And so I would say it all depends.
Yeah.
It totally depends on your situation. I think one of the main factors is your health, because if you ask the question, how would I know the perfect age to draw Social Security? Tell me when you're going to die, and I can show you the absolute actuarial perfect age to draw Social Security. Without knowing to the day when you're going to die, then we start looking at things like, well, what is your health? And then what does your plan look like? Have you been planning? If you've been planning, the person who's planned and is ready to retire at 62 or to start drawing Social Security at 62 has a couple of things in order. Likely they're debt-free.
Yeah. Likely
they've got a plan for health insurance, which is a way to have some sort of income, but not a lot of earned income, or in technical terms, modified adjusted gross income, which affects what you're going to pay for your health insurance. And retiring at 62 and not need to take Social Security.
Right.
Because the amount of Social Security that you will draw increases meaningfully on a monthly basis between 62 and let's just say 67. It keeps increasing all the way to 70, but that's where it's a crapshoot, because you don't know how long am I going to live? And this is where you look and you say, well, if you've got one spouse, maybe one draws, one doesn't. There are all kinds of really cool strategies, but how you draw Social Security, at what age, all these things, one of the biggest financial decisions you're going to make in your lifetime.
You said crap. Shoot.
Yeah.
Oh,
that's like dice.
Soup. I thought you said soup. No. Because it sometimes feels that way when you're trying to figure out how to optimize Social Security. Your certified financial planner is going to help you optimize your Social Security. They are. If they're doing comprehensive financial planning, not just trying to sell you some widgets, they're going to optimize your Social Security. And no one knows the age at which they're going to pass. And so there's short of that, there's no ability to craft the perfect plan. But based on all 6 areas of your financial life, they'll be able to come up with, hey, here's the best option. 65. Now, there's 2 important things that happen at 65. I'll hit the lesser important one, and that's the age at which your HSA turns into dual purpose, okay? And we don't talk about this enough on this show, but your HSA, anytime you draw money out of your HSA, as long as it's for a qualified medical expense, it comes out tax-free. Or if it's a reimbursement from a qualified medical expense that occurred when you had, a HSA covered plan, you can draw it out and not pay tax on it. Fantastic. No tax, no penalty. But if you've been stuffing that thing to the gills and you're worried that might not have a lot of medical expenses coming up, at age 65, that's when you can start drawing money out of your HSA and treating it like it's just a 401k or IRA, meaning you pull the money out and it's taxable because it wasn't just for medical expenses, but there's no penalty. Okay, so tricky, but that's at age 65. Why not age 59 and a half? Again, because these lawmakers have no idea what they're doing. So be aware of that at 65. The big thing at 65 is Medicare.
Yeah. So and it used to be your retirement age was almost by default, it was 63 and a half. I worked till 63 and a half. I hop on Cobra for 18 months, and then I hop on Medicare, and then my health insurance is taken care of. That has changed because it is easier to get health insurance before age 65. At 65, there's a huge change in how you approach your health insurance. Mm-hmm. And so you hop on the Medicare system, and you have a choice really between a Medicare Advantage or a Medicare supplement and a drug plan. So there are, once you get to 65 and you're slowing down, I can tell you at 53, I'm already slowing down. Everything is going to change, and it's incredibly complicated. So what you need is kind of your guide, your Sherpa, the person who's coaching you in your financial life to walk you through when should I do this, and hey, if I'm still working at age 65 and I have a choice to stay on my employer's plan or to hop off and hop onto Medicare, which one should I do? And so there's as I look at financial planning, I've always thought, well, tax planning really is really the most important area that we help people in because it's so complicated. But medical insurance really between 55 and 65 now almost trumps that.
I know. And, we 10 years ago, 12 years ago, there was lots of discussion and complaining and frustration about Affordable Care Act. But it's here, guys. It's here. And, Kevin, I don't think I would have said that 10, 12 years ago, that outside of tax planning, maybe health insurance or health insurance planning, it would be one of the most important. Not until they changed all the rules with the Affordable Care Act. Yeah. So that's age 65. You're going to make the biggest health insurance decision of your life. If you're still working and covered by a group plan, then you can delay that decision a little bit. But you got to be working with your CFP along the way. So you've got to plan for that. You don't miss those important ages. Because listen, if you miss that age, you're going back to that soup I was talking about. There's penalties and all that sort of stuff. Age 67, that's going to be for most of us listening from this point forward here. That's your full retirement age for Social Security. So that's the age at which you can draw your quote unquote full Social Security. And it's the age at which you can work as much or have as much income as you want and still not be penalized on your Social Security. As Kevin mentioned earlier, if you delay at 67, your Social Security will continue to grow all the way up until age 70, about 8%. Right now, with where the market is, what can you find that's going to pay you 8% a year every year? I don't know many options out there.
No.
So a few other ages that we've got to hit important in your financial life. So that and more coming up on the Wise Money Show with Korhorn Financial Group. Lindsay, do you want me to record right now something that you can place right there? Sure. So I'll just make it like 5 seconds. Lots of other ages that are important in your financial life. So go check out the podcast or check out the show on the YouTube channel. Just search the Wise Money Show. Check it out there. Right.
Are we going to the fourth?
We're going to the fourth.
Oh, my word.
So you can cut that in right after and then that's all the time we have. Yeah, there we go. All right, so YouTube, there's a few different radio stations that the show airs on, and one of them only, they don't give any commercials in between, so that gives us a little more time, but they can't give us the full hour, and so they get shortcut. They only get 3 segments. My goodness.
If you're listening, call WFRN. Tell me you want the whole hour.
That's right. So I'd say that glass is half full still, but I'd rather have it full.
We're certainly grateful. So a couple of things, Mike. 1960 is when 67 is your full retirement age.
If your birthday is 1960 or after, well, pretty soon, guys, in a bill or law forthcoming, that will be moved to 70. It will be moved to 72. I can't tell you when. It just has to. They will. They will cut benefits. They will have to cut benefits, and that will be one of the creative ways of cutting benefits without saying they're going to cut benefits.
Right. So, when you hear them talking about entitlement reforms, that's going to happen. It's not hugely popular for that to happen, but it's a math problem.
My guess is, so you said 1960 is that cutoff age. My guess is there will be one at 1980 and then maybe one at 2000 where they just keep pushing that back.
So you were talking about what's that investment that my payout is going to increase 8% per year if I don't take it? And that triggered me back to what I told you I really wanted to talk about today, which we can't really talk about.
I-bonds. So this is not a bond issued by Apple. It's a Treasury Direct inflation bond. The rate changes every 6 months. It's unbelievable, 7.2% right now.
No, what I want to talk about is inflation, and at 7%, using the rule of 72, in 10 years, everything you're buying today is going to cost twice what it costs. So this amazing Central Michigan University.
What did it cost? What's it worth?
Dude, we're not going there. But the price is, it's going to double.
Yeah.
And you say, well, if that's going to dub, okay, nope, I'm gonna rant.
This is why we needed to stick to the original plan. We talk about these ages instead of inflation. It's hard to talk about it and stay.
Yeah, let's stick to it.
Okay.
So is there anything beyond QCD at 70.5?
No, that's it.
Okay.
Right. I don't know. I don't know if we'll get into listener questions. I think we should hit these and then put it all together.
Yeah.
My guess is that's going to take the full segment. I could be wrong. If I'm wrong, then we'll hit a question.
Okay.
So, all right. In your 70s, is there anything, to worry about with your finances? Yes, there's a couple important ages you've got to be aware of. We're going to help you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn. Stay up to date on all Wise Money content. Find us online, Korhorn.com. You can find us there, but wisemoneyshow.com. And then all over social media. Wherever you're at, we are there as well. Search the Wise Money Show. Follow us there, engage with us there, submit questions there. You can do all of that. And so check us out. All right. So we're talking about the most important ages in your financial life. And as we talked about earlier, being aware of these ages is one thing, but then planning ahead for that next transition, specifically the one at age 50 where you've got catch-up contributions, or the ones for Social Security, 62, 67, for health insurance, 65. You've got to be planning for those ages well in advance. And so that's why it's important that you know chronologically, which we've done today in today's show, from 18 to what's going to be 72, lots of important ages. So 67 was full Social Security. Okay, which
if you're born in 1960 or later,
correct. If you're born in 1960 or later, but you don't have to draw at that time. You can continue to delay it. Work with your CFP. Do comprehensive financial planning. Next age is 70 and a half.
70 and a half used to be a big age, but that's connected to the next age we're going to talk about. So let's just talk about 70 and a half. At 70 and a half, I can do something called a QCD, a qualified charitable distribution, which means likely, and again, this is where when we met with some great folks recently who said the reason why we wanted to meet with you is because we don't do tax planning. We ask folks, hey, who helps you with your tax planning? Well, they're self-prepared, and they have an investment sales guy who does a nice job, put together a nice portfolio for them, and it's doing well. But they're not getting the holistic help that they need. So as we're talking, and I asked the question, when's the last time your investment guy talked to your tax gal? Or you can reverse that, your investment gal, talk to your tax guy, whoever. When is your team coordinated and talking together to strategize and come up with the best strategy? And then are they implementing that strategy? And so at 70 and a half, I'm going to just go out on a limb and say it's likely, if you're charitably inclined, you should start giving to charities directly from your retirement plans.
Yep.
And again, work with a financial planner, make sure they're certified. That person can help you with the logistics of that. Because again, we're setting up a new operating system for how do we give money.
And this applies to all of you. If you're giving to any charity, the folks that I'm giving $500 a month to the church. Yeah, at 70 and a half, you should have that coming directly out of your IRA, going directly to the church, not to you and then the church. Okay, because if it goes out of your IRA to you, it's going to show up on your tax return. Okay, and then when it goes from you to the church, you're going to get a contribution, a donation slip that you'll turn into your CPA, but they won't do anything with that because odds are you're not itemizing your taxes. Therefore, when the money goes from you to the church, it doesn't help you on your taxes. Now, is that the reason you give? No, it's not, to get the tax benefit. It isn't. But if there are tax benefits available to you, take advantage of them, because that keeps more dollars in your pocket. I'm going to trust that you're a better steward of those dollars than the government is. Just my hunch, okay? The other reason why we still highlight this age as being important for this QCD, qualified charitable distribution reason, is note, even though they changed the age for your required minimum distribution, a qualified charitable, what's that? What are you smiling at?
I didn't know. I just realized there was an age that slipped past the goalie here.
Oh, really? We got to pick one up? Okay.
Yeah.
Okay.
No, finish.
All right.
Good.
So these qualified charitable distributions count towards your required minimum distribution. It counts towards this I'm forced to take some money out. How much do I need to take? This counts as that. A Roth conversion does not count as this. So the fact that that's in the tax code, that this counts for your required minimum distribution once you're forced to take it, very helpful. All right. So what did we miss? I had a hunch.
Yeah. No, I'm sure there's more than one, but it just dawned on me. So tell me, Michael Paul Bernard, what is significant about age 70?
At age 70?
What stops growing at 70?
Social Security.
Yes.
Yep. Well, we mentioned it. We just didn't highlight that.
So
specific
if we back up before 70 and a half and go to age 70, at 70, between 62 and 70, your monthly benefit for Social Security grows. And it gets bigger every month until you hit age 70, and then it stops growing. So if you haven't started drawing Social Security and you're 70, start drawing it right now. An interesting little factoid: if you're over full retirement age, and we said, hey, in 1960, your full retirement age would be 67. If you're over full retirement age, you can actually go back 6 months and get a lump sum. Mm-hmm. Now, your benefit for the rest of your life will be smaller.
Yeah.
Slightly smaller because of you've given up 6 months of growth on the benefit amount. And I've had folks that have waited just knocking on the door of 70 and said, nope, I'm drawing it now. And I just decided that I want that $20,000 check for the last 6 months worth. Mm-hmm. So they took the money.
Let me throw one at you here. Okay. You're working with your CFP, you're doing some creative tax planning, and you want to not draw Social Security for a couple of years so you can do some Roth conversions, some other things. So you turn it on in January of a certain year because you say, well, these tax strategies are done. But you wanted a lump sum. So on January, you say, I'm going to start drawing now, but I want to backdate it 6 months. And that pushes that income into that next year, that next tax year. Mm-hmm. But you get a lump sum as if you started drawing in July of that previous year. Just an idea, throwing that out there. Work with your CFP. These ideas that we're sharing aren't ones to say, oh, that sounds like a good idea, I'll just run with it. No, that's why we're always going to tell you, take a comprehensive approach to your financial life, because this is complicated. And that's a, what is it? It's an if-then sort of relationship. You've got to look and say, well, this idea, how does it ping against this? How does it ping against this? How does it ping against this? Does this make sense? And so consider it.
Yeah, all ideas in a vacuum make sense. And so sometimes you hear something like, oh, yeah, that's awesome, let's do that. And then you look and you're like, well, but if I do that, this is the...
All right, so that's at age 70. Now let's get to the 72, which was the last age on my list here, although there might be others. But at age 72, that's the new required minimum distribution age. Now, right at the beginning of 2020, we didn't really have a lot going on, like nothing to worry about like this virus. Oh, yeah, we did. But there was a huge tax law change that rolled out and started 1/1 of 2020. It was actually passed and proved in law at November of 2019, but it became effect 1/1/2020. It's the Secure Act. And at that point, all these changes took place, and we were communicating them. And then a month later, the entire world was in crisis. So you might not be fully aware of this. But required minimum distribution moved from age 70 and a half to age 72, and some other rules changed.
And your required minimum distribution, that is jargon a little bit, so it creates some confusion. And we're going to simplify it. And if you have retirement plan money, whether it's still in a 401k, it's in an IRA, whatever it is, and you're retired, you are required to take a required minimum distribution. And to simplify that, think in terms of about 4%. So if I had $100,000 in my IRA, I've got to take out about $4,000. If I don't take out $4,000 in the right year, I'm going to be penalized 50% of that, or $2,000.
And then have to report that $4,000 as income as well on your tax return. So it's not like, all right, I've paid my penance here with the $2,000. No, you still have to claim it as income.
Yeah. So this is where I would want to be planning for my required minimum distribution that I'm going to have to take at age 72 when I'm in my late 50s. And I would be looking at the trajectory of the investments that I have and say, which ones of these should be allowed to grow unfettered, and which ones of these should I be possibly converting from IRA to Roth IRA? Should I be taking the money out and spending it and make that my lifestyle to begin with? There's all types of different planning opportunities as it relates to this. And if you don't plan before you hit age 72, there's a plan. There is a plan for you, and you will have to abide by that, like it or not. And that 4% that you have to take out at age 72, that percentage gets bigger as you get older because it's based on life expectancy.
Yeah, and so that's horseshoes and hand grenades, right?
Yeah.
You're going to have to do an actual calculation, a specific calculation to determine what your required minimum distribution is. But yeah, around 4% at 72, and then like 4.1, 4.2, 4.4, 4.6. Soon it's 5, then 6, then 7, then 8% of what's in your IRA. So this is sort of the capstone that it illustrates the importance of what we've been talking about this entire episode, because Kevin, you said you've got to be planful for this in your early 50s. I would argue when you're 18, let's go back to that, or 21, being aware that at some point, like if at that time, if you say, I've got my whole life ahead of me, I have no idea what I'm going to have to juggle financially, but I want to get started on the right track and I want to save a lot. Then if you say, well, I have no control over this, but if I'm saving a lot, by the time I get out there in retirement, do I want to be forced to draw a certain amount of money out that could push me into different tax brackets or whatever, or do I want to have dollars that are growing and positioned in a tax-free account? So to me, being aware that this is out there should impact your decision-making all throughout your life.
Yes.
Right?
Yeah. Well, this is why you need a comprehensive financial plan, so that you can address all of these issues.
I mean, the other thing that I would tell you is you might say, well, I'm in an okay tax bracket right now, okay tax situation right now, and I'm trying to invest and grow my dollars, blah, 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 blah. Well, listen, look ahead. If nothing changes, what tax bracket will you be in when you're forced to draw a certain amount out at age 72? Well, do you like that tax bracket? Because that tax bracket, it won't go back down from there. Like, that's sort of permanent. Yeah, will they change tax laws? Sure. They'll make small tweaks, but it never changes at that point. So be planful, work with your CFP.
And if you have two lives, you can pay a lower amount of tax on a greater amount of money.
All right. That's all the time we have for today. I hope you have learned something from this. Share this with others. But thanks for being here. On behalf of Kevin Korhorn and all of us at KFG, myself included, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.